Last week, Berkshire Hathaway struck a $26 billion deal to buy all of Burlington Northern Santa Fe Railroad, the largest acquisition in company history. He called the deal an all-in wager on the American economy. He's in New York for a town hall event that he held with Bill Gates at Columbia University yesterday. He graciously agreed to stay over in New York an extra night, and I am pleased to have a good friend of this program and a good friend of mine back at this table. Welcome.
Thank you, Charlie. I'm pleased to be here.
It's great to see you. It has been, certainly from the middle of 2008 to the middle of 2009, one incredible year.
One incredible year. And one to a lifetime, I hope.
Yes. Tell me about it for you.
Well, it really was an extraordinary time in this country. We came closer to a financial meltdown than certainly any time I've ever seen, and probably in certain respects there was even more panic than the Great Depression because it came on so fast and so unexpected, and the whole country wanted to deleverage, corporations, individuals, and fortunately we had a government that responded. And it was when we talked last, it was a little question of whether Congress would respond like they should. They finally did, and I felt they would in the end. I mean, in the end, they come together for things that are this vital to the country. But we had the right people in Washington. If we'd had a group that had behaved like a deer in the headlights, that deer would have gotten run over.
Yeah. So Paulson and Bernanke and Geithner were the right people at the right time. And you don't know what might have happened if others had been in those positions of power.
No, I can think of others. I'm not going to name them, but I can think of others where the ending would have been with us in the abyss rather than just peering down into it.
You made some investments during that period,
right?
General Electric, Goldman Sachs.
Goldman Sachs.
But you just pulled out the big elephant gun.
We may have used most of our powder in that one, too.
You said I stretched to the last nickel for this one.
Yeah. Why
did you do it?
Well, I felt it was an opportunity to buy a business that is going to be around for 100 or 200 years. That's interwoven with the American economy in a way that if the American economy prospers, the business will prosper. It is the most efficient way of moving goods in the country. It's the most environmentally friendly way of moving goods, and both those things are going to be very important. But the biggest thing is the United States is going to do well. I mean, we can't move the railroad to China or India. At least I haven't figured out how to do that. So it's a little like the Rivers of that song about New York. We have to make it here, or we can't make it anywhere.
Frank Sinatra.
But it does move 400 it moves a ton of goods 470 miles on 1 gallon of diesel. It replaces a train replaces 280 trucks on the road, and it emits far less into the atmosphere that's damaging than trucking. And it moves 40%. When I'm talking about the whole rail industry, it moves 40% of the goods plus.
And you have new port of entries like Houston that will bring in a lot of goods through the Panama Canal.
And we're going to have more people in this country, and they're going to be using more goods over time. And sure, there's a bad year from time to time, and in the next 100 years there'll probably be 15 bad years, and I don't know what order they'll appear, but I also know the railroads will be essential to the country.
Now, when you called Charlie Munger and said, I'm thinking about this, did he say right on Warren, or did he say, how about this?
Well, if Charlie said right on Warren, I figured I had the wrong number. No, I mean, that would be the wrong number.
It's not the likely
that
response.
Might be my wife or but Charlie gave it kind of a low-level grumble, and that is real endorsement from Charlie.
But I mean, he also pointed out, it is said that there was this was a regulated industry.
Sure.
This was an industry that was capital intensive.
Very capital intensive.
This was an industry.
You spend money.
That was unionized.
It was unionized. You spend money in this business regularly, every day. You're spending a lot of money, repair track, or add rolling stock, whatever it may be. So it's capital intensive, and it is regulated, and it will continue to be regulated. It will continue to be capital intensive. I think that what the service provided by railroads is so important in many ways. I mean, it's the right way to move goods around the country to the extent that you can do it, and it's far more attractive in terms of global warming than using trucks, for example. So it will be here, and if we get a reasonable return on the added capital investment, because it'll take added capital investment, we'll do okay. And
reasonable return's good enough?
Reasonable return's good enough, Charlie. I mean, 50 years ago I was looking for spectacular returns, but I can't get them. I mean, we have $8 or $10 billion to invest every year. And we're in the utility business, and it's the same thing there. I mean, when we build electric generation or something of the sort, we shouldn't expect a spectacular return. We're building things that are essential to society, and people need our services. They really don't have any choice in the case of the electric utilities, for example, and sometimes in case of rail. And we should get a decent return on that. I mean, it's enough to encourage us to keep putting money into the business, but we're not entitled to spectacular returns.
You carry coal.
Well, that's a big one in terms of tonnage. Yeah, very big.
And if in fact we wean ourselves off coal, is that a big problem?
Well, we will wean ourselves off coal over time, but we can't change the 40% of electric generation that comes from coal. We can't change that next week or next month or next year, but we will reduce it over time, and we should reduce it over time.
And you can add other things to carry, and changes will be.
There will be more grain to move, and there'll be more of all kinds of chemicals or whatever it may be. There will be more things moving around this country 10 or 20 or 30 years from now.
Knowing your idea about moats, is it a pleasing idea that no one is likely to get into the railroad business?
Well, if they wanted to reproduce the Burlington Northern Santa Fe, it might take $100 billion or so, and
and 100 billion years.
They'd have to be a real sport.
Yeah. And they also are modernized today, are they not? I mean,
enormously, enormously. The railroads, take a railroad like BNSF, they're moving far more ton miles of product with less in the way of people, less in the way of fuel. Railroads have become far more efficient over the years. There were 1.5 million people employed in the rail industry after World War II. Now there are about less than 200,000 in the United States, and they're moving far more goods. So it's really become efficient. You watch those 130-unit trains double stacked.
You had other railroad companies in your portfolio.
Right.
You're selling them?
I've already sold them. Yeah, I've done that just to facilitate the transaction. I think they're good investments, but I would have held them if this hadn't happened.
When you look at the future, there's also the argument made that this is something that goes with your philosophy today. Get out of cash and get into assets, because we don't know what's going to happen to the dollar.
Well, cash is always a bad investment. I mean, when people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. On the other hand, you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around. And cash, we will always have enough cash around. But anytime we have surplus cash around, I'm unhappy. I mean, I would much rather have good businesses than cash. And we found a chance in the last year or thereabouts to deploy. We came in with something over $40 billion in cash, and we've got about $20 billion now, and we've had some earnings. So we put a lot of cash to work, and I like that. No, I'd much rather own a good business than have cash.
And it is a hedge against the dollar?
Well, you can say all assets are a hedge against the dollar. I mean, but all you know is that the dollar is going to be worth less 10, 20, 30 years from now. I say worth less, not worthless.
Right.
You want to watch that. But it will be, and that's true of almost every currency that I can think of. The question is how much it depreciates in value. But cash is not a place that.
Now, why is that?
Well,
because the dollar is going to be worth less.
Because we'll print more of them in relation to the amount of goods that are moving. If we dropped $1 million of cash into every household in the United States today, everybody would feel very good, except the people that invested in things that were denominated in dollars. And,
Exactly.
There will be no tendency toward deflation in this country over time, or in virtually any country.
Tendency toward inflation.
Absolutely.
Okay. No, the alternative with me, Joe. The alternative. I don't like fixed dollar investments at all. I don't like short-term bonds. I don't like long-term bonds. We own a lot of short-term bonds, but that is not because we like them. That's just a parking place. But the alternative, in my view, I mean, certainly commodities can be an alternative, but the alternative is income-producing assets of one sort or another that are not fixed dollar type investments. And so I've said consistently for the last few years, I would vastly prefer to own common stocks than fixed dollar investments over a 5 or 10 year period. I don't know about the next 5 hours or 5 days. And that might very well extend to rental real estate. It might extend to farms. I mean, an investment you're looking for something where you put out money now, and that asset that you buy gives you back more money over time. Now, the problem with commodities is that you're betting on what somebody else will pay for them in 6 months. The commodity itself isn't going to do anything for you. So there's two types of assets to buy. One is where the asset itself delivers a return to you, such as rental property, stocks, a farm. And then there's assets that you buy where you hope somebody else pays you more later on, but the asset itself doesn't produce anything. And those are two different games. I regard the second game as speculation. Now, there's nothing immoral or illegal or fattening about speculation, but it is an entirely different game to buy a lump of something and hope that somebody else pays you more for that lump 2 years from now than it is to buy something that you expect to produce income for you over time. I bought a farm 30 years ago, not far from here. I've never had a quote on it since. What I do is I look at what it produces every year, and it produces a very satisfactory amount relative to what I paid for it. If they closed the stock market for 10 years and we owned Coca-Cola and Wells Fargo and some other businesses, it wouldn't bother me because I'm looking at what the business produces. If I buy a McDonald's stand, I don't get a quote on it every day. I look at how my business is every day. So those are the kind of assets I like to own. Something that actually is going to deliver and hopefully deliver to meet my expectations over time. A piece of art, may go from $1,000 to $50 million, but it's dependent on what the next guy wants to pay me. The art itself, the painting itself, is not going to dispense cash. So I have to find somebody that's going to like it more. And with an asset like gold, for example, basically gold is a way of going long on fear. And it's been a pretty good way of going long on fear from time to time. But you really have to hope people become more afraid in a year or 2 years than they are now. And if they become more afraid, you make money. If they become less afraid, you lose money. But the gold itself doesn't produce anything.
Well, speaking of gold, though, we're looking at gold prices, and they were at another record high. They're up another $3 today, $1,434 an ounce. And there have been some big hedge fund managers, like a Paulson or a David Einhorn, who have really buckled down on these bets. Why would you steer clear, and do you think what they're doing is the wrong thing?
Well, I just don't know. I don't know whether cotton's going to go up. I mean, we use a lot of cotton, and I've watched it go from 80 cents to $1.90. We use a lot of copper, and I watched it go from $2 to $4 plus. So, I mean, there's all kinds of things in this world that are going to go up and down in price. And maybe hamburgers will tomorrow. But I don't know how to judge that. I do know how to judge, to some extent, the earning power of some businesses. And the real test of whether you would like it as an investment is whether you would be happy if it never got quoted again, and just in terms of what the asset did for you. But that doesn't. I will say this about gold: if you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So if you took all the gold in the world, we could have a cube that went down there 67 feet, 67 feet high, and that would be the whole thing. Now, for that same cube of gold, it would be worth, at today's market prices, about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you could have a choice of owning a third of all the stocks in the United States, or you could have a choice of owning that little block of gold, which can't do anything but kind of shine there and make you feel like Midas or Croesus or something of the sort. Now, for $7 trillion, there are roughly 1 billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all of the farmland in the United States. You could have about 7 Exxon Mobils, and you could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, maybe touching it, and fondling it occasionally, and then saying, do something for me, and it says, I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything, cotton, corn, soybeans, 7 Exxon Mobils, just think of that. Add $1 trillion of walking around money. maybe call me crazy, but I'll take the farmland and the Exxon Mobils.
All right, that makes some sense. Carl, you've got a question too?
I'm still trying to get the image of Warren fondling a giant block of gold out of my mind.
Just fondling it occasionally was what stuck with me.
Bring me a giant block of gold and you'll see me fondle like you've never seen before.